Assalamualaikum. We are from Group 5, ACT3141, Audit Group 1. So we're going to present about revenue cycle. So our group consists of me, Nafisa, Ilya Rosmaisara, and Shuhada. So for the first thing is, I'm going to explain about process in revenue cycle. There are 5 important steps in this process, which is for step 1, we will receive customer order. Next, obtain credit approval, and then shipment of goods, billing to customer, and lastly, cash collection. Sources of document that involves in this revenue cycle. We have sales order, credit approval, shipment, billing, and cash collection. And now we're going to go one by one. As for sales order, the document involved is customer sales order. For credit approval, we have credit approval form, open order report, and for shipment, we'll have open order report and shipping document. Meanwhile, for billing, we have sales invoice, sales journal, customer segment, account receivable subsidiary ledger, aged trial balance of account receivable, and last but not least, for cash collection, we're going to have remittance advice, cash receipts journal, credit memorandum, and write-off authorization. As for journal entries and accounts, we'll see what the journal entries and accounts that involved in this revenue cycle. As for journal entries, first we're going to have sales journal. As you can see on June 5, the account debited is Ali Company, and we need to debit accounts receivable, credit sales, and also debit cost of goods sold and credit inventory. The second journal entries involved is cash receipts journal, and if you can see in the table on 3rd June, the account credited is sales, so we have to debit cash, credit sales, and also debit cost of goods sold, credit inventory. And as you can see, you can read the other journal written on the different date for cash receipt journal. And lastly, the journal entry involved in the cycle is sales return and allowance journal. On the 10th June, the account credited is also Ali Company, so we need to debit sales return and allowances, credit accounts receivable, and also debit inventory, credit cost of goods sold. As for accounts that involved in this cycle, we have 3 main accounts, 3 main elements, which is sales transaction, cash receipt transaction, sales return and allowances transaction. Okay, for sales transaction, we're going to have the account involved is sales, account receivable, bad debt expenses, allowance for uncollectible account, or known as allowance for undoubtful debt. And moving on to the second one, which is cash receipts transaction, we'll have cash discounts, account receivable, and cash. And lastly, sales return and allowances transaction, we're going to have sales return, account receivable, and lastly, sales allowance. And as you can notice here in the slide, all 3 elements of accounts have account receivable because the main account for revenue cycle we have account receivable.
Next, I'll present about the flowchart of revenue cycle. It is started when the company get order from customer via email or telephone or faxes. When the company get the order, they will proceed with sales department, where this department responsible for receiving the order and prepare a sales order. Then, the sales order sent to the credit department for customer credit check. Once they approve the order, it will be transferred to shipping department. When the sales order complete, the company will gather all goods to be shipped. After order is shipped, the shipping document is created and sent to account receivable with the sales order. Then, it should update the inventory to the warehouse after order is shipped. When there is account receivable, it is responsible for taking sales order and shipping document and generate sales invoice that company will send to the customer. The account receivable department will keep track of customer by using the invoice. But when the company receives the payment, the account department will remove the balance from account receivable and document it. There are two types of risk in the revenue process, which is control risk assessment and inherent risk assessment. In control risk assessment, there are three major steps in setting the risk for revenue process. First is understand and document internal control. The auditor needs to understand the five components of internal control. The components are control environment, entities risk assessment process, control activities, information system and communication, and lastly is monitoring of control. Next, the auditor should plan and perform tests of control. The auditor should examine the entity's revenue process to identify relevant controls that help to prevent or detect and correct material misstatement. For example, inquiry of client personnel, inspection of documents and records, walkthrough and re-performance. The last step is set and document the control risk. When the tests of control have been completed, the auditor should set the achieved level of control risk. The auditor should document the achieved level of control risk for revenue process using either quantitative amount or qualitative terms such as low, medium, and high. Auditors should consider inherent risk factors in examining revenue process. There are four factors that may affect the process, which are industry-related factors, complexity and contentiousness of revenue recognition issues, the difficulty of auditing transaction and account balances, and lastly is misstatement detected in prior audits. In industry-related factors such as profitability and health of industry, level of competition within industry, and rate of technological change also affect potential misstatement. Level of governmental also may affect sale activity. For the second factor, which is the complexity and contentiousness of revenue recognition issues, the revenue recognition on long-term contract, lease contract, installment sales may involve complex calculation. Revenue recognition also may significant impact on the cutoff and accuracy assertions. The third factor is difficulty of auditing transaction and account balances. Management estimate for allowances for uncollectible account and sales return can be difficult to audit because subjectivity that may involve in determining the proper value. For the last factor, misstatement detected in prior audits. Misstatement in previous audits is good indicator that misstatements are likely to be present during the current audit.
Okay, next I will explain about the internal control, assertions, and other procedures that involve in the revenue cycle. Okay, the first assertion is occurrence. What is occurrence? So occurrence is when all the revenue or cash received in the transaction and event have been recorded, have occurred to the entity. There are two possible misstatements that might be happened, which is fictitious revenue and revenue being recorded, but the goods are not shipped or the service are not performed yet. So for every assertion, I will take only one of the possible misstatement that will be discussed with us. Okay, so the I will take fictitious revenue. So the internal control that might be involved is segregation of duties where the order entry function will be deferred to the billing function. So the audit procedure that can be done tests of control which the auditor will observe and evaluate the segregation of duties, while the analytical procedure that can be done is the auditor will compare the data with the budgeted revenue, and for the substantive test of details, we can use vouching techniques which can ensure that sales invoice, customers' orders, and shipping documents are described accurately. So the next assertion is completeness. Completeness is where all revenue and cash received on the event or transaction that should be recorded have been recorded. So the possible misstatement that might be happen in this assertion is goods shipped or service are performed, but the revenue not being recorded. So there are three internal control that might be involved in this assertion, which is numerical sequence of documents, shipping documents matched to sales invoice, and sales invoice reconciled to daily sales report. So let's take a look at the second internal control, which is shipping document matched to sales invoice. The auditor can take tests of control to trace whether the shipping documents are matched accurately to the sales invoice and sales journals. Other than that, the auditor also can take substantive analytical procedure where the comparison of data is being made, which is the detail of the unit shipped with the revenue and production records. The auditor also can take tests of detail to trace shipping document to sales invoice and sales journals uh, being tested in details. So the next session will be authorization. Authorization is where all revenue and cash receipt transaction or events are properly authorized. There are two possible misstatements that might occur, which is goods shipped for customer who is not creditworthy and shipment made at unauthorized prices or terms. So let's take a look at the second point, which is the goods shipped for a customer who is not creditworthy, which the internal control that might be involved is process of credit authorization. So the auditor can take test of control where we examine the sales order for evidence of the proper credit approval. So the next assertion is accuracy. Accuracy is the amount and other data relating to record revenue and cash receipt transaction and event have been recorded appropriately. So the possible misstatement that might be occur is revenue recorded at incorrect monetary amount. The internal control that might be involved is sales invoice agreed to the price and shipping quantity on shipping document and sales order. So the auditor can perform test of control, which examination of sales invoice for mathematical accuracy being done. Also, substantive analytical procedure can be made in for the comparison of data, sales invoice to authorized price list. Recomputation of information on sales invoice also can be done in a substantive test of details. The next assertion is classification. Classification is where all revenue and cash receipt have been recorded in a proper account. So the possible misstatement that might be occur is revenue transactions are not properly classified. The internal control is a chart of accounts where the auditor can perform test of control by reviewing of sales journals and general ledger. Also, the auditor can perform substantive test of detail where the auditor can review the sales journals and general ledger, more details in the test of detail. So the last assertion is cut off. Cut off is where all revenue and cash receipt of transaction or events are recorded in a correct accounting period. The possible misstatement that might be occurred is revenue recorded at wrong period. So the internal control that involved is all shipping document forwarded to billing function daily and daily billing of goods shipped. Let's take a look at the first point, which is revenue recorded at the wrong period, and the internal control is all shipping document forwarded to billing function daily. So the task of control that might be performed by the auditor is comparison of dates on shipping document to sales invoice. Also, the auditor can perform substantive analytical procedure where the comparison of revenue recorded for period shortly before and after audit period. The auditor also can take substantive tests of detail where comparison of dates in shipping document to sales invoice being done in more detail. So let's continue our presentation with the case solution. So this is the question. You can read it by pause this video. You can also read and download it in the WhatsApp group in folder 5. Next, I will present the answers that I've been discussed with my groupmate, which is for the first question, identify the major factor affecting client business risk and acceptable audit risk for this audit. So the major factor affecting client business risk is first, since a hospital having modern facilities is being constructed in a nearby city, it will increase the competition. Thus, this will increase the chances of financial risk. Second, the hospital has been making major losses for the past few years. The third is the country tax might not be able to make up the losses than past few years. And the fourth major factor affecting client business risk is the large number of loans to two banks, and both of them do not want to extend their credit. Therefore, after considering all the factors, the auditor has to establish a low acceptable audit risk. So for the second question, what inherent risks are you concerned about? So for this second question, I am concerned about the consequence of unintentional error in billings, recording sales, cash receipt, account receivable, and bad debt. Since the unemployment rate is increasing, there is a significant risk of increasing in bad debt. Besides, inherent risks that might be involved in industry-related factor due to competitive environment as new modern hospital is being built in nearby city.
The third question is, in this audit of the sales and collection cycle, which types of tests are you likely to emphasize? Our answer is, we are likely want to emphasize on the test of control to this sales and collection cycle. This is because, as an auditor, we want to detect whether the financial statements is free from any material misstatement. As mentioned in the case, this company did not have expertise in accounting personnel, so there is possibility in making error in recording the data. This also to check the reliability of the internal control towards financial reporting. Therefore, we decided to have additional audit evidence through this test to ensure the control in the revenue process operate efficiently.
For this question, for each of the following, explain whether you plan to emphasize the test and give reasons. Okay, the first test is test of control. Yes, we're gonna emphasize this test because from the case, we can see that this company have management issues, and therefore to test the effectiveness of the internal control in detecting material misstatements of the financial reporting, we decide to make this control test. Okay, second test is substantive test of transactions. And for this test, we think yes, this test should be emphasized because if we do not get enough evidence from previous tests, which is control test, where this substantive test is important to prove or to strengthen the status of the management control, and also to have additional evidence. And for analytical procedures test, we think this test is not really important to emphasize, since the material misstatements from prior years and present is not huge, and pricing policies remain unchanged. And lastly, for test of details of balances, since we likely want to emphasize on the test of control and substantive test of transactions, we need to also emphasize on this test too, since this test of details of balances is related with both of the test of control and substantive test of transaction. So the reason is, it is to prove that test of control and substantive tests are reasonable to the involved accounts that are affected by the sales and collection cycle. That's all from us. Thank you.